And that when I speak about this issue and when people from the Treasury Department speak about this issue, I think we come to it with a fair amount of humility. And we come to it with humility for a few reasons. The most important reason is that on the other end of this policy are Ukrainian lives and a brutal war. And so, that type of motivation, I think, hangs over our heads all the time. The second reason we come to this with humility is as Michael noted, this is completely novel. And we are in the process of building this policy as we implement it. And so we never want to declare victory too early. We always need more analysis, more time to understand what's going on. And I'm sure we'll continue to refine it over time. But sort of to talk about the motivation for the price cap from the outset, when Russia invaded Ukraine now a year ago, it was a little bit like a tire company sprinkling nails on the highway and then being there at the end to fix all the tires and profit from it. So Russia created this awful crisis. We saw rises in energy prices, and then Russia was using this increased revenue to fight this war. And from our perspective, that was 100% unacceptable. So we needed a solution. And we had two primary goals from the outset. The first was to maintain stability in global energy markets as much as possible. So if there was a spike in energy prices like the one we saw at the onset of the war, that meant not just more pain for the United States, it meant obviously more pain for the global South and for countries who bear disproportionate pain when energy prices spike. It also means disproportionate pain for Ukraine and other countries that we obviously care deeply about. The second goal was then also to reduce revenue received by Russia. So we've always had these dual goals from the outset: stabilize global oil markets and reduce revenue as much as possible. And sometimes that seems like it's in tension with one another. So in June of 2022, the European Union put in place what is known as the Six Sanctions Package. And the Six Sanctions Package did two things. The first, it banned seaborne imports of Russian oil. So as of December 5th, Europe would no longer take crude off of tankers. And beginning February 5th, 2023, Europe would no longer accept refined product from Russia. The ban was consequential, but the really consequential part of the Six Sanctions Package was the second part, which banned Western companies from Western countries from European countries in the Six Sanctions Package from participating in the trade of Russian oil. So under the Six Sanctions Package, you could not have a Greek ship with UK insurance carrying oil from Russia to Mumbai. It wasn't destined for a European port, but you couldn't use the Western services to transport that oil. This really mattered because, for example, at the time it was put in place, 90% of Russian oil was being traded on ships that carried UK insurance. And the UK was going to follow whatever the EU did. And so there was a real risk at the time of severe shut-in of Russian exports. Now, maybe that sounds like a great idea, but at the time, there was a real worry that this would spike the price of crude, and then later on in February, spike the price of refined products. So some of the analysts from places like JP Morgan thought that the price of oil would go to 185. Other analysts thought it'd be around 150. Some thought it'd be 130. But in general, there was a consensus that a ban on Western services to transport Russian oil meant a sharp spike in energy prices. Now, whatever your probability for a global recession is when oil is at 110 or 115, if it goes up to 185, double or triple that probability. 185 oil looks terrible for the global economy, looks terrible for developing economies. And it makes the oil that Russia is able to export that much more valuable. And so just to say from the outset, when Russia shuts in a barrel of production, two things happen. One, it doesn't receive the revenue from that export, but it makes all the other barrels that it can export that much more valuable. So our concern was that by shutting in Russian production, it would mitigate any of the impacts on revenue. And in sort of more extreme cases, it could actually offset all of the impact on revenue. So we had to do something, and the good-natured six sanctions package, we felt like we just wanted to introduce a slight adjustment to that and enter the price cap. And the idea was to say, you still have a ban from the EU on services used to transport Russian energy, but there's an exception on the ban, and that's if the Russian energy is traded for extremely low levels. And we saw an expansion of the coalition, so it's no longer just the EU, but joined by the rest of the G7 and also Australia. And so you have a broader coalition with which to implement this new regulation. So over the summer, we would travel to Europe and meet with our counterparts and start to hash out some of the details. Details like, will it just be a certain dollar per barrel cap, or will it be a spread? How will this be implemented? And so we spent an enormous amount of time talking with private industry, because the orientation of this sanctions package was so different than anything that's been tried before. I mean, Michael's right, this was completely novel. Usually when you have sanctions, the Treasury Department or other entities that levy sanctions say, look, you can't trade good X with country Y. But this is completely different. We actually wanted the trade of Russian energy to continue just at low levels. And so it was imperative that we went to private industry and said, how can we make this work for you? Now, we settled on something called the attestation and record-keeping model, where oftentimes services that are involved in the trade of energy don't know the price of that energy. So you could be a ship owner who's carrying oil, and you may not know the price of that oil. Or you may be an insurance company housed in the UK, insuring a fleet of ships, and you don't know what the values are of the diesel being traded, or the kerosene, or the crude. And so we needed a model that would be flexible to the way that industry does business. And we came up with the attestation model and said, essentially, there are three different buckets of service providers. There are those like banks that know exactly what the price of the product is that's being carried. There are some that are some service providers that sometimes know the price of the oil that's being carried. And there are those service providers, like insurance companies, that almost never know the value of the energy being carried. And so the basic framework was to say, if you're a service provider and you don't know the value of the energy that's being carried on the ship or that's being traded, it's incumbent upon you to get an attestation from a reliable actor and then engage in record keeping. So basically just file it in a drawer for 5 years. And it was your responsibility to receive credible information. And if the Treasury Department felt like you were either intentionally skirting that obligation or going to a non-credible source, there would be action taken. Industry seems to think that this has been working. We're on the phone with them all the time. We've gotten relatively positive reviews. Russian barrels continue to flow, and roughly a quarter of them are traded under the price cap, as far as we can tell, for Russian crude. So here we are, 3.5 weeks into January, with this completely novel scheme. And so a reasonable question is, how is it working? And the price of Brent is $88, not $135, not $150, not $185. We're talking about a global economy which feels fairly stable, and price spikes are not on everyone's mind right now in terms of crude. And this general scheme seems to be working. And we're looking at Russian revenue. Now, the data is tough to come by, but by some estimates, we've reduced Russian revenue from the trade of oil by 35%. That's certainly a success. It's not an end game. We're not where we need to be, but Russia is undoubtedly making less money from crude than it did before. You're seeing widening spreads between the price of Brent, so non-Russian oil, and Russian oil. If I'd come and sat in this chair 13 months ago and said, guess what? Russian oil sells for $30 or more less than identical oil that just comes out of different soil, you would have said I was crazy. So what we've effectively done is bifurcated this market, and for a ton of reasons, not just the price cap, but partly probably because of the price cap, Russian oil is now seen as an entirely different commodity than oil from other places. And so it sells for much cheaper And that's how we're able to achieve our dual objectives, which is, again, to stabilize oil markets while having lower revenue. Our next task, looking forward to February 5th, is to put price caps on refined product. So Russia exports about 2.5 million barrels of refined product every day. This is everything from kerosene and diesel, high-value refined product, to things like naphtha, which is used in petrochemicals and other things like that, that looks more like crude. But we looked across all these different product categories and tried to come up with a scheme that would work for refined product. And our suggested solution was to have a dual price cap. And our solution was to basically group all these refined products into two different categories. One was higher value refined product that typically trades for more than crude, and another was lower value refined product that trades for less than crude. And it's a little bit messy doing it this way. We could have a dozen different price caps, one on kerosene, one on vacuum oil, another on diesel. That felt a little too tough to implement. At the same time, just having one price cap seemed a little too, I want to say crude, but it's very hard to cap the price of one product, which is trading for $120, and another product which is trading for $50 with the same price. So our proposed solution, which has generally been accepted by the rest of the G7, is to have a dual cap, one for a group of products which typically trade for more than crude, and another for a set of products which typically trades for less. So, one question is, well, what are you going to set the price at? We don't know. We're engaged in conversations with the G7 and the rest of the coalition actively at this point. We don't know what the price will be, but the goal remains the same. The goal remains the same, which is to have Russian barrels continue to flow on ships to the global economy, but just at dirt cheap prices. And so, we're ultimately aiming to set the price caps as low as we can while preserving the ongoing trade of this various refined product. The last thing I'll say is people say, well, Russia will just shut in. There's no way you're going to sell into the price cap. I think we've already shown they will sell into the price cap, and they are selling into the price cap. But they may very well choose to roil global markets by shutting in oil production. But what we've done is we've created the incentives for them to continue trading. So we've set the price above the marginal cost of production. Russia still receives a little bit of profit. We're just trying to squeeze that profit. And if Russia ultimately decides to shut in energy, well, that means that the Russian economy will deteriorate even faster than it is already. So we've left them with no good options. And what we've done is basically cross off the list what Russia had been doing for so many months after its invasion, which is creating a crisis and profiting from it. That's no longer an option for Putin. That's no longer an option for Russia. So Russia only has bad options to choose from. So we're cautiously optimistic at this point. We have a lot of work ahead of us. And again, we're trying to stay humble and remember that the other end of this policy has lives at stake. So thank you. So I guess we can invite the rest of the panel up, and happy to have a conversation.